Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com, here with a Forex strategy video in which we have to cover a lot of the heavy event risk that we have for next week. But we're not going to cover it in terms of what the scenarios are, what my outlook is. I'll do more of that in the trading video. This is going to be more about an assessment of how the markets are positioning into this week. Now, it's important to understand where markets and how markets are biased towards major event risk or a general expectation of volatility, and that combination of expectations can tell you whether, as you receive these pieces of data, and of course I'm talking about the Fed rate decision on Wednesday as a key catalyst for this conversation, you can establish whether there's going to be a meaningful surprise, and in that surprise, whether you're going to have big market movement. All right. So we know going into next week that we have heavy event risk, and we are talking about specifically the Fed rate decision, though there are plenty of indicators besides that, like the Bank of Japan rate decision on Friday morning, as well as a number of CPI figures for the UK and US. We know how important that is for the UK. All of these are going to be noteworthy, and they tap into the bigger fundamental themes. Certainly the competitive monetary policy strategy, which has given us very substantial trends, but also it could even tap into risk trends. Now for risk trends, I look at the S&P 500. And we have seen the S&P 500 and its expectations for volatility in the VIX indicator, which I use pretty regularly, and we're going to look at that, and not just the VIX for the capital market. We're going to look at the VIX for the FX market in a little bit more detail. All right, but I do want to restate that we are talking about a lot of event risk, absolutely, but we are also looking at a historical period of quiet. Right? This is a chart that I continue to reference, and it's for good reason. This is a reference to the typical S&P 500 performance during the month of December, a truncated month because of the holiday, and investors know that there is a tradition of unwinding positions, preventing new large trades being taken because of the year-end capital flows and the year-end shutting down of shops relatively early. All right, so during this period, we see low volume, the lowest of the year typically, and high positive return on risk trends. All right, does not necessarily mean it has to be the same thing every time, but this is typically what happens. And that representation of risk has a very important impact on the FX world. Now, we have seen the VIX indicator enough against the S&P 500, and as we've talked about numerous times before, there is typically a negative correlation between this index and the S&P 500. All right. There is essentially a long bias to the S&P 500. Buy and hold is the standard for most investors, and thereby it typically has a positive implication for risk when we actually see drop in the S&P 500. So fear is the nickname of this indicator, the fear indicator, because of this relationship. And you can see that volatility is relatively low. We've come back to the lows. This goes back to 2011. I pulled all the charts just to 2011. There are some bigger swings back there, but they're not necessary for our conversation today. You can see that we're relatively low, and this VIX is based on a 3-month outlook. All right, so the volatility indexes and the ones that we'll see for the FX market are based on options. All right, and from options we can back out the market's expectations, also what they're currently pricing in, or what it has been for volatility as of late. And you can do this because there are known variables in the pricing of options, but the, as we call it, premium that you pay for options, there is one unknown, intangible, and that is generally what the expectations are for volatility going forward. All right, so and to a lesser extent interest rate expectations, but that's a conversation for a different day. But here is the general FX measure for the FX market, or the volatility measure for the FX market. This too we have seen. I've talked about this on a number of occasions. As you can see, and as you would expect, the US dollar as my benchmark for the FX world usually rises as volatility rises. That would be a very good cue in to exactly what we expect from what we call the FX market's safe haven currency. All right, so the U.S. dollar, a safe haven currency, rises when volatility or quote-unquote fear rises. That's exactly as we would expect. Although we have had some deviation recently, in 2012 there was certainly a substantial deviation, and we've seen a more extreme pullback than the dollar has been afforded in this particular correction. Now remember, this is still medium term, so this has a 3-month forecast. A lot's going to happen in 3 months, including this very quiet month that we're currently riding through, and then into January and February, where the probability of a taper is somewhere on the order of 70%. All right, but there's a lot of speculation about what can happen in the coming week. All right, will the Fed taper in December? Well, it's not necessarily the highest probability in the FX market. We can confer these charts regularly. Expectations for a December taper are not the highest, but they certainly exist, and that creates tension in the markets. Someone's going to be surprised, whether it be bullish or bearish for risk or the US dollar. Someone's going to be surprised, and that's exactly what creates volatility. When, let's say, half of us are positioned for the market to rise and the other half are positioned for it to fall, what ends up happening? When it actually does rise or fall, the other half of the market is going to have to cover their positions, or at least a portion of them, and that feeds the move. All right, so this level of divergence is exactly what we look for. Now, in terms of looking at the medium to short term, here we have the dollar versus my short term and medium term FX volatility measures. Now, the red one, obviously very interactive, very rapid, is the shorter term, 1 week expected volatility measure going forward. All right, and the purple is the medium term. Now, when we actually compare these two, we can see that there is much greater premium given to volatility in the near term. The zero line would mean that in the short to medium term, they're expecting the same level of volatility. All right? When it's that low, there are low expectations of near-term volatility. It can be an extreme, but it's typically a very quiet week. Now, this shows that this can actually be quite volatile, knowing that there is a 70% probability of a taper over the next 3 months versus a much smaller probability of a taper over the next week. It's interesting that this comparison is so dramatic. It's the highest we've seen since around early August. All right, and we know that there was a lot more taper discussion back then. Now, when we look at the actual measure of volatility for the FX world, you can see here that this is a subtraction of the short-term actual volatility versus the medium-term actual volatility. So how active has the market been in the past 3 months, the FX market, and how active has it compared to how active it has been in the last 1 week? Generally, very low. All right. And we would expect this. We would expect this because we have had some very quiet markets, despite the fact that we have such remarkable looking technical setups. And we've talked about these technical setups and how attractive they are, like the euro dollar. We talked about the implications of that heavy round of resistance that we had up here at about 138.50. All right, and we did hold up that top, yet. And we've actually given to a short-term break here on this past session after that 7-day run, but has it necessarily turned to a massive reversal? And will it find follow-through? That's a question for volatility. All right, what are the market's expectations of a more active market? And volatility typically is going to pick up for the Euro USD when it drops, because the US dollar is the safe haven in this theme. You can see that volatility has picked up, but it is not posting new highs, expected volatility. And in 1 week's time, that covers Wednesday's Fed rate decision. All right, so not necessarily huge expectations for big swings on the Euro USD. Now let's look at some of the other majors, all right, because they have interesting patterns as well. I've been watching the dollar yen, and I actually have a very small size in the dollar yen after it posted a break of that previous swing high back here. All right, and we have been tracing out this rising trend line, but like the other yen crosses, this looks like a very exposed currency cross, or the crosses in general, the yen crosses, to a possible reversal. A lot of people are trying to call reversals. So what's the probability of a reversal? All right, and generally during reversals, we're talking about high level volatility, right? So well, let's look at the 1 week dollar yen implied volatility. This is actually picking up quite aggressively. But if you look back in the past, the spikes in short-term volatility that you have here have actually coincided with bottoms. All right? Now the general activity level will pick up to support the performance of this currency pair, which is interesting. All right? It's very interesting because a shot higher in volatility would generally mean a risk aversion move. Now for the dollar yen, we know this is a confusing pair. Both dollar and yen are considered to be either funding currency or safe haven currency, so it's an unusual circumstance here. But the shot down here has actually coincided nicely with the bottoms. We have something of a jump here, but it's not necessarily a standout peak. So some uncertainty here with this pair. This one will be very interesting. Another one that will be exceptionally interesting, and we're getting more and more interesting as we go, is going to be the Aussie USD. All right, we have had a pullback to 90. We slipped below 90, and the hard floor here is 88.50. This is a swing low, multi-year swing low. We've tentatively slipped below this trend line floor, but we have a very dominant bear trend in place. All right, what's the probability of a major breakdown? What's the probability of a reversal? A reversal usually supports risk, and continuation would be risk aversion if it kicks in. Well, look at that volatility measure. Now, as volatility picks up, that's risk. All right, risk aversion. So typically when we flip this upside down, it's more one-to-one. All right, that drop to multi-month high, or that rise to multi-month high in short-term volatility is a good measure of risk. All right, this one, the traders, I'm not saying this is going to be a Q into an 88 break, but what it tells us is people are positioned for a possible 88 break. And if we don't get a taper, we don't have heavy risk aversion, guess what? This might actually turn into a reversal as short-term volatility drops off, and the Aussie dollar is obviously positioned somewhat skewed short, and that unwinding can give us something of a boost. And finally, the pound dollar has a lot of interesting technical appeal to it. It had this pullback here. We've come back to this 162.50, very important level. What's the probability here that we break that 162.50? This is less of a exposure to the traditional risk theme, but it certainly still has its exposure to the Fed taper. All right. Now, once again, if I flip this upside down, you see that there is greater correlation to the U.S. dollar, so the U.S. dollar plays the safe haven role. The volatility figure picked up, but if you want to see a severe break on 162.50, it's probably going to have to do with that event risk. All right. And we have to see something that is of surprise, either for risk aversion or something very supportive of the U.S. dollar. That's on Wednesday. However, remember that we are already right at that floor. Will we hold at that floor? Will we try to break it? If we try to break it, it might be a false break. All right, might be a bounce to release some of that pressure before the Wednesday release. So think of all these factors, but think of it as you go in with your scenarios. Just assess how the market is positioning and biased, because in that surprise, whether they are confirmed or whether they are denied, there is price action. There is volatility. All right. Hopefully this helps you in looking at the markets in a little bit different way, but volatility and expected volatility is very important to our trading. Go trading out there, guys. Hope you have a fantastic weekend. We'll do our next Forex strategy video on Monday.